Welcome back to Alpha Recap, your post-market wrap from stockalpha.ai. We closed the day and we're breaking down what mattered. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. Markets closed down modestly today, nothing dramatic, but there was a clear rotation under the surface.
Right. Quick snapshot. The S&P finished the day down about 0.3%. The Nasdaq 100 slipped roughly 0.2%, and the small cap benchmark fell about 0.6%. So small caps underperformed.
That pulled the overall tape lower, but this felt more like rebalancing than panic. Investors moved toward defensive areas late in the session.
So what really stands out here is the defensive bid. Utilities and some real estate names picked up steam as traders stepped back from cyclicals and higher beta small caps.
Exactly. It wasn't a broad sell-off. It was a rotation, pairing exposure to riskier stuff and shifting into yield and stability.
Let's walk through the three big drivers behind today's tone. First, flow and positioning. With indexes near recent highs, traders trimmed winners and reduced risk in smaller names.
Yeah, that tracks. Second, sector headlines. Specific news in utilities, real estate, industrials, and payments created selective buying and selling rather than an all-market move.
And third, the Fed backdrop. There wasn't a blockbuster economic print today, but because the Fed says it's data-dependent, any hint of sticky inflation or a strong jobs picture keeps people cautious about growth names.
I mean, when you step back and look at this, the data calendar is like the market's mood ring. Traders were just waiting for anything that could change the policy path.
Sector-level action was interesting. Utilities led the day. Investors favored regulated cash flows and dividends in a late-cycle environment.
Large-cap utilities especially helped limit the decline. Income and lower volatility were the theme there.
Real estate names also got a lift. Deal activity and clearer cash flow profiles in some REITs drew buyers who wanted predictable income.
Right, and that real estate support was very selective. Developers and property owners with visible earnings got the attention.
Tech and communications were mixed. The Nasdaq 100 closed lower, but it outperformed the broader index for part of the day. AI chatter kept media pockets busy.
Oracle stayed in focus. Search trends showed the stock was getting a lot of attention today. Roughly 20,000 searches popped up in the data we saw.
20,000 searches. Not bad for a software name. But that momentum attracted profit-taking too, so gains were checked.
Industrials felt pressure in certain names as supply chain risk stories resurfaced. Companies that flagged execution risks or exposed supply chains underperformed.
At the same time, some industrials that are positioning for AI-driven productivity improvements saw buying on the dips. So again, selective, headline-driven flows.
Energy was kind of range-bound. Upstream got a little buying. Refiners and midstream names pulled back on softer crude spreads and demand uncertainty.
Banks traded cautiously after JP Morgan Chase announced it planned to rein in lending intensity to manage credit risk and the balance sheet. That was read two ways by investors.
Right. Some saw it as responsible risk management. Others treated it as a sign that credit growth might slow, which could weigh on financial earnings if it persists.
Quick reactions? Noted.
Okay, digging into individual headlines. Visa was under pressure because short sellers were circling, and that created nervousness across payments names.
Short seller attention tends to amplify volatility across a whole sector. Payments and fintech peers felt that today.
Oracle, we already mentioned. Enterprise AI positioning kept it in focus. Even without a major earnings event, headline-driven interest mattered.
ON Semiconductor filed an 8K today, and combined with the broader industrial supply risk theme, semiconductor equipment and component names felt the pressure.
Also worth noting, a cluster of smaller and mid-cap companies filed 8Ks. Names like BKV Corp, GigaCloud Technology, OppFi, and a few others. That drove volume and volatility in those specific names, but it didn't move the market as a whole.
And the cannabis and media notes produced episodic winners. Again, stock-specific stories rather than whole sector breakouts.
Let's pivot to macro and what traders were watching. No big prints today, but the overarching theme stayed the same. The Fed remains data dependent, so traders are sensitive to anything that changes the policy outlook.
If inflation or employment prints surprise hotter in the coming weeks, the market would likely price in a higher for longer scenario, which hurts rate-sensitive growth names.
Conversely, signs of slowing credit growth or softer demand could cap economic upside. The bank lending story we talked about is one to watch.
Okay, technicals and tape read. The tape was signaling short-term caution rather than a breakdown. Breadth showed concentrated selling in small caps, while big caps held up better.
Benchmark stayed within recent ranges. A sustained move below this week's lows for the S&P would push the odds of a deeper pullback higher, while reclaiming intraday highs with follow-through would wipe away today's cautious tone.
Volatility gauges ticked up on the small cap weakness and headline moves, but they didn't surge to panic levels. That's consistent with a rotation and repricing, not systemic stress.
For traders, the practical read is to watch breadth and small cap behavior for confirmation. If selling broadens, the story changes. If selling stays concentrated, it's just rotation.
So what should listeners watch overnight and into tomorrow? Number 1. Any economic surprises on inflation, retail sales, or industrial production will be amplified because positioning was cautious today.
Number 2, Fed speak and global central bank comments. Nuances about a higher for longer stance can reprice both stocks and bonds quickly.
Number 3, sector-specific headlines. More deal flow in real estate, fresh filings in cannabis, or further short seller activity in payments could drive outsized moves in pockets of the market.
And number 4, corporate guidance and earnings. Companies that can demonstrate margin resilience and stable cash flow were the ones that attracted buying today.
Bottom line, today was a reminder that near recent highs, investors will use headlines as an excuse to rebalance. The small cap underperformance, down about 0.6% versus larger cap stability, highlighted that preference for big, stable names and income.
That dynamic favors utilities and cash flow stable real estate in the near term, while creating tactical opportunities in oversold, high-quality cyclical names if macro and Fed signals remain benign.
Quick takeaways?
1. This was rotation, not panic. 2. Watch small cap breadth for the next clue. 3. Defensive yield and predictable cash flows mattered today.
And for investors, stick to your time horizon and risk tolerance. Diversification showed its value today.
Honestly, I was a bit surprised by how organized the defensive bid was, but that's probably a good thing. It kept the market orderly.
Yeah, absolutely. Final note, if you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. We'll be back after the next close to recap what moved the markets and why. Good night.